Welcome back to Retirement Dakota with Scott Tucker. I'm your host, Scott Tucker. Today we're going to talk about tax planning. And this could be tax planning that can apply to a 50-year-old. I'm 50 years old, maybe you are also. This is also going to be tax planning that can apply to a 60, 65, 70-year-old, 80-year-old person. So what we do is we help folks plan for retirement. We're financial planners. We help folks plan for retirement. Now, tax planning is not the same as tax preparation. Tax preparation is what you do when you do your TurboTax, your tax returns, or you go to H&R Block, or you go to your CPA or your enrolled agent. Tax return preparation, it's like going down the highway and you're looking at your rearview mirror. You got your tax return that you're doing from last year and you're just staring at that rearview mirror. You're going down the highway, you're going to have a bad accident if you're not using the windshield. So the windshield is really important for us as financial planners looking at helping you plan for your retirement, so we can see where we're going. And we can see when you're going down the highway at a good clip, you might be able to see a couple miles down the road, a mile or two. And we need to be able to see a mile or two down the road, not just look at the rearview mirror. We need to know that you're not retiring too soon, that you're not filing for Social Security too early, that you've saved enough. We need to take into consideration future taxation and also future cost of living increases in Social Security, future medical expenses. A whole lot of things go into this when we're planning for retirement. But tax planning is especially important for folks that are kind of upper end of Gen X, a little bit older than me, and then also the baby boomers. Tax planning is really, really important. And we do a lot of work with baby boomers and upper end Gen X. And what most folks find, and even younger folks find this too, but it really gets to be important as you get closer to retirement. Most folks find that, let's say most of their money they've saved for retirement, they've saved it tax deferred. This means you've never paid federal income tax on most of your money. This is something we find most commonly anyhow. So maybe 90% of your money is tax deferred, and maybe only 10% of your money is tax free, like in Roth. So when we think about that, if you've never paid tax on your traditional 401k, 403b, your traditional IRA, your deferred comp, your 457b plan, your thrift savings plan if you're a federal employee, if you've never paid taxes on this money that's tax deferred, you've got a silent partner, don't you? So on your 401k, whose name is missing? It's not your spouse's name that's missing on the 401k on your statement. What's missing is Uncle Sam. Uncle Sam's your silent partner, and you just may have put that out of your mind. You may have been told that, well, when you retire, you're going to be in a lower tax bracket. We find that not to be the case for 90% of the people we sit down with. If you're watching this right now, you're 50, 60, 70 years old, you're most likely, most of the people that we sit with, 97%, are most likely going to see higher taxes in retirement, not lower. Some people, when they first retire, they see their taxes go down, and about 5 years later, they see them come back up. We call that the income tax ski jump. So we'll talk a little bit about that too. So if 90% of your money is tax deferred, not tax free, you've got to at some point pay tax on that. If maybe over here we have our tax free money, maybe it's Roth. Maybe 10% of our money is Roth. Now we meet with people all the time. And if you'd like, click down below in the description. There's a link where we can set up a phone consultation or do a Zoom with you, and maybe move towards an in-person meeting if you like as well. We meet with people all the time that don't have anything in Roth. That happens quite a bit. But probably the most common scenario we see is about 90% tax deferred. And the tax deferred, how is that tax deferred? Scott, you keep saying tax deferred. What do you mean? So the ways you can have tax deferred money, you can have traditional IRA, 401k, 403b, deferred comp, which is called 457b, so deferred comp, TSP, thrift savings plan, and you can also have SEP IRA, simple, KEO, a whole bunch. But the most common tax deferred ones are going to be these here. So traditional IRA, 401k, 403b, SEP, simple, KEO, TSP, deferred, I think I said them all. Anyhow, so this over here, in the Roth, we could have, this could be Roth IRA, could be Roth 401k, and so on. You can have Roth versions of all of these employer plans. Some employer plans don't have the Roth option even today. It's kind of frustrating. But money that you have in the Roth side or in the tax-free side if you remember that toy from the 70s or the 80s, that Slinky, if we have our Roth and we grow it bigger, there's no increased tax obligation or anything for the future because all of that is growing in a tax-free Slinky. If we have a Slinky on the tax-deferred side over here, and you picture your 401k, your traditional 401k, which is something we see most commonly, probably 401ks, and we see the others too, 403bs, 457, TSP, IRA, whatever. But traditional retirement accounts, we'll say it's a traditional 401k, for instance, that you have that Slinky, and as you grow the Slinky higher, we just grow the money. We're growing it in a tax-deferred Slinky. We're making the tax problem worse by growing the money. So it's important that we consider some different ways to make some maneuvers now to potentially minimize your lifetime income taxes. You might have most of your money saved tax-deferred, as we just mentioned. Here's your Slinky. So this is the maybe the traditional whatever. It could be 401k, IRA, whatever. Deferred comp, TSP, 403b. So you have the Slinky, and if all we do is grow it larger, we're heightening the amount of future income tax. What we might want to do, not specific advice, your mileage may vary, we might take a chunk of it each year and do a Roth conversion. So we might have a Roth over here. So you have your traditional on the left-hand side, and over here you have your Roth, which is your tax-free account. And what we might want to do, and this is not advice, not specific advice, if you want to talk to us, click down in the description. There's a link there where you can book free phone time with us, and we'll walk you through what might be best for you. So we could do a conversion from the tax-deferred side over to the tax-free side. Maybe we do that each year. And what we're doing is we're getting out of hock with the IRS. And depending on what state you live in, you might be getting out of hock with your state too. So over here's the tax-deferred area. If we move over to the Roth side, maybe a chunk at a time, not specific advice. Now we pay the IRS as we move the money over, but we pay the IRS sooner than later. So we pay the IRS before this traditional IRA grows larger and larger. We also think that in the future, potentially, federal tax rates could go a lot higher. So they're going to go higher in 2026. They could go a lot higher yet after that because the federal debt is out of control. The spending, the borrowing's gotten really crazy. So if we move the money from year by year, so this would be maybe a 5-year period of tax planning here, take a chunk and Roth convert it. Now it's in the tax-free column. And so we'd pay the IRS. Roth conversions are federally taxable. Okay. Now in some states, they are free of state income tax. Right now in Illinois, you can perform a Roth conversion. You pay Illinois nothing. And right now, we still have the last couple of years of the Trump tax cuts. We pay a discount to the IRS these next couple of years. And then in 2026, rates go higher. And after that, they could go even higher yet because of the federal debt. Once we get in the tax-free Slinky over on this side, and it would take a few years for us to do this, probably 5 years a lot of times is a sweet spot. Now we have all of our money, let's say in Roth IRA as an example. So now if we grow this money, it all grows tax-free. Now the income from Roth is of course tax-free. There's in fact no place on the federal 1040 for you to put the Roth income. Let's say you go into retirement and all of your income is from Roth and from Social Security, just those two income sources. You will actually pay 0 federal income tax if all of your income in retirement comes from Roth and Social Security. If you went into retirement and you had a whole bunch of money coming at you from tax-deferred accounts like traditional IRA, 401k, 403b, deferred comp, TSP, subsimple KEO, all that, the money from tax-deferred accounts, if you left your money in traditional, would be taxable in retirement and can make up to 85% of your Social Security federally taxable. So really, tax planning is a giant opportunity for most baby boomers, and we probably ought to talk about it. Look down in the description, there's a link there. We can book some phone time together. Let's talk about income in retirement and how we look at it for tax planning. Now, one thing we might want to do is we want to really consider where do we take our income from. So when it comes into tax planning for retirement, we need income. The paycheck stopped, right? And so where do we get income from? We could have several sources. Maybe you still have some traditional money, tax-deferred money. Maybe you have some Roth money. Maybe you have some what we call non-qualified. Non-qualified means it's not a qualified retirement plan with the IRS. Non-qualified could be a joint account with you and your spouse, or it could be an individual account that you opened up at home, let's say with take-home money, we call it. So take-home money is that's the non-qualified money. So traditional IRA, 401k type of stuff here. There's IRA, 401k, and all the others that are in the traditional category there. There's Roth IRA, there's Roth 401k. Okay, and then there's non-qualified, like a joint account with your spouse, or an individual account where you had take-home money and you opened up an investment account. So these are some common income sources. Another one people talk about is Social Security. What we see way too much of is folks want to file for Social Security too early. That sounds kind of weird, but we could walk you through your specific examples. If you click down below in the description, we'll spend some time on you with the phone or on the Zoom, and we'll walk you through what we're talking about there. When might or not, what might be a good time or a bad time for you to retire, a good time or a bad time for you to file Social Security. Most folks want to file Social Security too early. The paycheck stops, they panic, they say, I need income, I need to turn on my Social Security. For a lot of folks, especially baby boomers and upper Gen X, it's usually not true that you should have your paycheck stop and your Social Security start right away. Most baby boomers and upper end Gen X folks should have a little gap there because they need to do some Roth conversions and things, and they can also take income from the tax-deferred account. So where might we take income from first? This is kind of counterintuitive for a lot of people. A lot of people don't want to pay federal income taxes on what they've saved for retirement, but you got to ask yourself, do you think tax rates are going higher or lower in the future? I think they're going higher. We know that some of the rates are going higher in 2026, and with the federal debt and that, we believe they're going to go dramatically higher thereafter. We'll have to see. I'm not Nostradamus, but that's what I think. So the traditional IRA, a lot of people say, well, I don't want to pay income taxes in retirement, so I don't want to take from there. We talked earlier about a slinky where we have a tax-deferred account, and if we're just going to grow that taller and taller, we're growing the tax problem. Right now, tax rates are historically low, and before we grow this any larger, why don't we take income from the traditional? And that specific advice, we'll have to talk about it. Go down in the description, you can book phone time with us, and we can walk you through that. A lot of folks say, well, this is tax-free. I ought to go right here. This tax-free, I want to get income from there. When your money's growing tax-free, why would you interrupt that? That's a good question, isn't it? So it might be, maybe it's the fourth income source we want to look at. If it's growing tax-free, let it keep growing tax-free, okay? And then some folks will say, well, I've got this non-qualified money, and yeah, I've got a cost basis in there, and long-term capital gains and all this sort of thing. This non-qualified money, it's not taxed terribly heavily in many cases when we access that. And I would say that there might be some other considerations to take into place here. Now, if you have some positions where you've lost some money, maybe we could pair up some of your losers and your winners, and we could do like a wash sale, wash those taxes out of there, and then you could have some tax-free money. But I'll tell you, this is pretty well tax-advantaged money. The most tax-advantaged money is the Roth. The next would be this money here, because you have a cost basis. You already had take-home money, you already paid tax on, then you invested it. And if you hold a position where you gain money, where you gain capital appreciation for 12 months and a day, now you fall under a better set of tax brackets under long-term capital gains. So for long-term capital gains, you have to hold a position for 12 months and 1 day, and then you get a better tax treatment. But so we're not really big fans of going after this. The worst money you have is your traditional money. Your traditional tax-deferred money is the worst kind of tax treatment you're ever going to have. It is better to get that taken care of sooner than later. So that's the first place to go. We don't want to go after the tax-free money, because tax-free money, you want to let it grow as long as you can. The non-qualified money, something else about the non-qualified money, it can be really good money to leave to kids or grandkids. So right now, and it's been this way for decades now, but you have a step up in cost basis, meaning step up in cost basis, not too easy to read. But so let's say you pass away and you have $1 million of McDonald's stock, and you bought it way back when, and maybe you put your cost basis was $100,000. So way back when you bought $100,000 of McDonald's stock, not specific advice. Not only would the food kill you, but you could lose a lot of money in any specific stock. So maybe way back when you bought $100,000 of McDonald's stock, or you bought it over a number of years. Maybe you worked out there when they used to be in Oak Brook. And so you bought this McDonald's stock, it appreciated over decades. You pass away, and it goes to your kids, now they have what's called a step up in cost basis. Whereas if you had sold the stock at $1 million, the government, the IRS would say you paid $100,000, that's your cost basis for the stock, you sold it for $1 million, you have a long-term capital gain on $900,000. Well, if you leave it to your kids, they get a step up in cost basis, meaning their cost basis is at $1 million. They can sell it for $1 million and they can diversify. That would be a sane move there. And so they would actually get this tax-free. So you paid $100,000 for the McDonald's stock, it went to $1 million, you pass away, the kids receive it upon your passing, they get $1 million of stock, and because of the step up in cost basis, their cost basis is $1 million, not $100,000. They now have $1 million they've received federally tax-free, so that can be really cool. Now down in this area here, a lot of folks want to go after the Social Security right away. If you've not dealt with the tax-deferred money through Roth conversions and using the traditional IRA and that here for income, we really generally are big fans of putting off the Social Security till later on. So one thing we don't want you to do is retire too early. The other thing we don't want you to do is file for Social Security too early, because you can really cheat yourself out of a great deal of benefits. All this can be things you don't want to hear, and we can walk you through if this scenario applies to you and how, and we can reason with you and show you what all the reasoning is. If you want to click down in the description, there's a place for us to get a free phone consultation. We'll walk you through all of this, and I think make better sense of it than I can just talking to you over YouTube. So let's talk next about beneficiaries. You may have kids, you may not have kids. You might have nieces, nephews, siblings, somebody you want to leave money to. You might want to leave money to kids and grandkids. So I want to ask you, what's the worst money to leave to the kids and grandkids? The worst money to leave the kids and grandkids is tax-deferred money. You're leaving your unpaid federal income taxes to the next generation. So you got to ask yourself, what kind of legacy do I want to leave? If I have unused money and I want to leave it to kids, grandkids, nieces, nephews, siblings, what type of money should I leave? The worst money to leave is going to be traditional tax-deferred money, like your IRA, your 401k, your deferred comp, your 403b, all that sort of thing. So that's the worst money to leave behind, because under the Secure Act of 2019, if you leave it to the next generation, they have to withdraw all of that money within a 10-year period. They have to pay federal income taxes on all the money they receive. At the end of the 10-year period, by federal law, the account has to be to zero balance. Your legacy is erased as if you were never here. Also, the kids get used to 10 years of elevated income. They feel like a lottery winner for 10 years, and then the income abruptly stops. So there's a lot there that I think is not what we would find ideal. Now, what would be the best money to leave to the kids and grandkids then? There would be tax-free money, of course, was what would be best to leave to them, because you're not leaving unpaid federal income taxes to the next generation. There's different ways to leave tax-free money to the kids and grandkids or the next generation. Tax-free money can take a couple different forms. One form would be, the most common anyhow, would be Roth IRA, that kind of thing. So let's say Roth IRA. It could be other Roth accounts like Roth 401k and that, but we already talked about how you probably shouldn't, when you leave the employer, the money ought to probably go with you, so it probably ought to be in a Roth IRA. A Roth IRA is tax-free to the next generation. And under the Secure Act of 2019, we can show the next generation how to use an inherited Roth where they can grow the money tax-free 10 more years after you're gone. At the end of 10 years, then they have to cash it out tax-free. But what's neat about that, you haven't left your unpaid federal income taxes to the next generation. You haven't increased the taxes to the next generation. You haven't pushed the kids into a higher tax bracket than they are from their own employment. You haven't done a number of things that could be really detrimental. So if we could grow the money tax-free 10 years after you're gone, that could be really cool. And what that would look like, so that's the one form of tax-free money you could leave to the next generation. So if we had a Roth IRA, your Roth can't become the kid's Roth. But your Roth, we could do a direct transfer into an inherited Roth IRA. So your Roth IRA can go into their inherited Roth IRA. Now, if we use the thing called the Rule of 72, and we have 10 years of tax-free growth, If we were able to get 7.2%, that's an if we were able to get 7.2% per year growth on the money you leave behind that's in the inherited Roth IRA, if we get 7.2% for 10 years, we double the money in that 10 years. So let's say you left behind a $500,000 Roth. Over 10 years, if you could make 7.2%, at the end of 10 years, it would be a $1 million Roth. And what a great legacy there. What an impact you've made. So now you left them a $500,000 Roth after you passed. We sat down with them and we said, hey, what you ought to do is put whatever money you don't need right now. Now they could take the whole Roth, $500,000 Roth, and they could take it tax-free today. We'd sit down with them though and say, hey, why don't we do a direct transfer of any of this money you don't need today, put it in an inherited Roth IRA, because if we could get 7.2% a year for 10 years, federally tax-free, we can make $500,000 of tax-free money into $1 million of tax-free money. At the end of the 10 years, they do have to cash it out under the Secure Act of 2019. But isn't that neat? And so instead of giving the kids an account that created, when you left them the traditional IRA money, you were giving them forced taxable income and getting them used to higher income for 10 years. What if you leave them a 10-year taxable income stream and they go get a 30-year mortgage? So they have 10 years of income, but they have a 30-year mortgage. You really set them up to fail a couple different ways. If we leave them the Roth money and we point out to them how they can grow it tax-free 10 more years after you're gone and potentially turn it into $1 million of tax-free money, we've made them savers, investors, and we've changed their whole mindset. If you left them that 10-year taxable income stream from the tax-deferred IRA or 401k, you made them spenders, squanderers, and taxpayers. You really didn't do them any favors. So I think that is a pretty impactful point right there. So I hope you learned a lot today about tax planning and that you learned some things that can be really impactful to your retirement. We want to talk to you. If you want to talk to us, click down below in the description. There's a link there where you can schedule a free 15-minute phone consultation. From there, we can go into a Zoom meeting or maybe an in-person meeting. We are federally licensed, so we can help you wherever you are across the country. And we look forward to talking to you in the next video.